This program was brought to you by PennyMac TPO. Visit tpo.pennymac.com to learn more about becoming a partner and starting your journey to greatness. With the people, products, and technology to take you there, it's why they say, at PennyMac, greatness lives here.
We're strongly committed to bringing inflation back down, and we're moving expeditiously to do so.
Welcome to The Interest. I'm Mike Savino. You just heard from Fed Chair Jerome Powell, who reiterated Wednesday his commitment to getting inflation back down to 2%. We saw that yesterday when the Fed approved a 75 basis point hike, which is more than what most experts thought would happen. Powell told reporters that the Fed felt the need to get more aggressive after new CPI numbers late last week showed inflation wasn't going down. In fact, it went up to a 40-year high of 8.6%. And at the same time, a University of Michigan survey showed more consumers were becoming pessimistic about inflation. Powell said the Board of Governors saw this as a sign that they couldn't wait for their July meeting to ratchet things up.
And we thought for a while, well, this is the appropriate thing to do. So then the question is, what do you do? And do you wait 6 weeks to do it at the next meeting? And I think the answer is that's not where we are with this.
Powell also said that the Fed will likely consider hikes of 50 or 75 basis points again in July, but he didn't want to rule anything out. Even a 100-point hike could be possible depending on the data. So what's going to happen to mortgage rates? We asked some economists, and they say that the Open Market Committee's decision shows members are worried they don't have inflation under control. And while mortgage rates jumped in the spring in anticipation of the Fed's actions, more aggressive hikes could push rates even higher. How high? One economist told us that he doesn't know how fast mortgage rates will rise, but he thinks 7% is likely by the end of summer, particularly if we see 75 basis point increases consecutively. Economists also say it's becoming harder and harder for the Fed to get inflation back down without sparking a recession. The Federal Reserve applied the brakes harder, making calibrating future monetary policy more difficult and reducing the odds that the central bank can engineer a soft landing. Powell also said Wednesday that he hopes the Fed's efforts will eventually bring the housing market back to normal. Prices keep going up even in the face of rising rates, and that combination is making it harder for consumers, especially younger ones, to afford the cost of homeownership. But can the Fed actually reset the market for us? We asked an expert.
That the more people have confidence in the Fed, that probably lends itself to a more stable interest rate environment.
Lenders are anxiously watching each move the Fed makes, waiting to see how the agency will handle inflation. Wednesday, Chairman Jerome Powell said the housing market is one area the Fed is focused on.
We need to get back to a place where supply and demand are back together, and where inflation is down low again and mortgage rates are low again.
Marty Green, a mortgage industry lawyer, was happy to hear Powell's comments, but he also says there's factors outside the Fed's control that continue to drive up prices.
Look at the data, it shows that we underbuilt for about 14 years after the Great Recession.
The country does have a huge inventory of unfinished houses not yet ready for the market. Powell says increasing rates may not be enough to restore calm in housing prices until supply opens up.
So that it's still a very tight market, so prices may keep going up.
Green agrees with Powell. He also thinks mortgage rates will bounce around as long as there's disagreement on whether the Fed has control of inflation and is moving the market in the right direction.
If you have people betting violently differently on those two, how high that's going to need to be, I think you're going to continue to see a fair amount of volatility.
For the Mortgage News Network, I'm Christine Stewart.
Home builders are trying to push Congress to help make home buying more affordable. More than 600 NAHB members went to Congress last week and talked with lawmakers about fixing volatile supply chain disruptions, helping with labor shortages, and relaxing regulations. Building material prices are up 47% since the start of the pandemic, and Fannie Mae estimates that the monthly principal and interest payment on a median-priced home has risen by $500 just since January. Earlier this week, we reported that builder confidence continued to slide for the sixth straight month. Meanwhile, mortgage rates jumped 55 points this week based on inflation concerns. That's the largest one-week increase since 1987, and it pushed the rate on a 30-year fixed to 5.78. While Powell says that the prices will keep going up, Freddie Mac says that the higher mortgage rates will lead to a moderation from the blistering pace of housing activity that we experienced coming out of the pandemic, ultimately resulting in a more balanced market. The 15-year fixed also jumped by almost a half point to 4.81%. A year ago, the 30-year fixed was at 2.93%, and the 15-year was just under 2.25%.
Brought to you by PennyMac TPO. Visit tpo.pennymac.com to learn more about becoming a partner and starting your journey to greatness.
For more on these and all of today's top stories, go to mortgagenewsnetwork.com.